if I write this LOI, I fully intend to see this deal through to closing, because if I'm the guy that writes that LOI, gets it accepted, gets in a negotiation, and either starts retrading on due diligence or backs out of the deal altogether, I can pretty much kiss my relationship with this broker goodbye.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 59. You might remember today's guest from episodes 33 and 34. During those episodes, I talked with Josh Sterling, and we discussed his buy and hold portfolio of single-family homes, multifamilies, and apartments. And we also talked about Josh's management company, Epic Property Management, which services the southeast side of Michigan, near Detroit, not necessarily in Detroit, but near Detroit. Josh is back today to talk about his latest acquisition. He recently purchased a 40-unit apartment building in Newport, Michigan. This is Josh's first syndication deal, and he's going to walk us through it step by step. Josh Sterling, thanks so much for being on the show today.
Brian, thank you very much for having me back. Excited.
Yeah, so a lot has happened since we talked over the summer, huh?
Yeah, it's been a good year. It was, as you mentioned, a great time to get a first syndication in. The market, as tough as it's been, presented us with a really, really great deal. And we went ahead and worked through that, put a syndication together, and closed this deal just right before Thanksgiving of 16. So just a couple months back now.
Great. Congratulations.
Thank you.
Now, I think we both can agree that it's a very tight market, and the deals that we both see coming across our desk, the majority of them just don't make any sense.
Oh, it's been it's unbelievable how bad they are. I'm still on a weekly basis seeing several deals from brokers in the area, and just it's amazing how far off the numbers are from where I would have to be to make almost every single one of them work. I'm probably at probably less than 5% of the deals I see am I even able to get past an initial look into it. And even less than that, obviously, can we even make sense to go out and tour? We had an interesting one just a few weeks ago. A larger brokerage in the area had found that we were fairly active here in this core market, and it sent us a small, just an 8-unit deal that when I ran a quick analysis, it penciled out to a 4.2 cap. Which is, I think those are mostly California type numbers. That definitely doesn't work for us. It actually would have lost money on a monthly basis for us if it ran perfectly.
Yeah, and that's based on your numbers, not the numbers the broker provided you.
Of course, yeah. The Pro Faca said it was a very good deal.
Yeah, and owning your own management company, Epic Property Management, you can pretty accurately project what your numbers are actually going to be.
I think that we're pretty realistic about it. Definitely we're conservative when we run these things, but as I'll tell you more even about the 40-unit deal that we purchased, even the best plans sometimes don't go exactly as planned. So even on that, which is definitely a great deal, we still had a few bumps in the road initially after purchasing the building. And with every building I've ever purchased, and probably every property I've ever purchased, there's always unforeseens. So I just rely on what my historic performance has been, and it's amazing, but it tends to track that even with future performance. So a little bit more conservative than the broker would like you to believe is usually the safer bet.
Well, yeah, brokers will typically present you with the best case scenario. But let's talk specifically about this 40 unit. I mean, a lot comes across your desk. What was it about this one that caught your eye in the beginning?
Well, yeah, a lot comes across our desk, and I would say every once in a while, it's fairly rare, but every once in a while it'll come from a broker that I have a good relationship with, and that's the key. This broker I've known for it's got to be 6-7 years, really, since I've been in the business. And you get to know these brokers, and it's more important than probably anything out there that broker. I know that broker and I trust what he's bringing me, but more so, he knows who we are. And my true belief is that a broker really mostly cares about closing the deal. At the end of the day, his interest lies in closing the deal, as good of a relationship we have and whatnot. So if you think about it from that standpoint, when a broker has a really good deal, he's going to bring it to a client he knows is going to close. So I believe that's what happened in this case is we got a call for that the broker had this deal. It sounded really, really good, as a lot of them we mentioned will sound at first, but ran some initial numbers, and it really did look great. So we went out, took a peek at the deal, and again, I had it's happened several times, but I was the first guy out to see it. So I guess the benefit of getting that first look is huge, but either way, the ability to be able to analyze and know a good deal when you see it was key.
Tell us about how you analyzed it. What specifically did you look at to say, okay, I'm going to take it to the next level and go look at the property?
Okay, so anytime I get a deal that comes to me, obviously I need to see some financials on it.
What do you typically want to see?
For me, I don't necessarily care what the soft expenses, or I call them the soft expenses in my world, but I don't necessarily care really what the expenses are that are standard, such as maintenance, lawn and snow, legal professional, those type of things I can come up with because I know what it's going to cost me. What I do care about is a few of the expenses that are hard numbers, like a property tax, sometimes an insurance, things like that are pretty much set with the property, right? We might be able to negotiate insurance down a little bit, but if someone's paying $7,000 a year for insurance existing, I can figure that I'm probably going to pay about that too. But what I really care about, the number that really matters to me, is a rent roll, a true actual rent roll. I'm not talking about a pro forma. We should be able to get $100 more per door, which is so common to see. I'm talking about what are the actual rents today, what is the actual occupancy, and if I can get that top line number, that rent roll number, as we did right away on this property, I can make a pretty quick analysis if it's going to work or if it's not going to work. My expenses, it's amazing, but they just track virtually the same every single time. It's going to work out to 50% if the tenants pay the utilities, and 55% if I pay them myself.
Yeah, exactly. That's what I always say too. I mean, your expense ratio is going to be 50%. I'll just repeat it. 50% if the tenants are paying their own utilities, and if you're paying the utilities, your expense ratio should be right around 55%.
And I've found, I'm sure you've seen the same, Brian, I've found over time that even if we have a year where we might beat that here and there, that may be because maybe a little bit of maintenance got deferred or was unknown, but over time it tends to track right back to that number.
Absolutely. But keep in mind, though, for our listeners, we are in Michigan, so that includes things like snow removal and some weather-related expenses that might increase our costs.
True. And I also believe that there are ways to operate a property somewhat cheaper, or actually maybe even significantly 5 or maybe even 10% cheaper on the expense ratio. I've seen people that are doing somewhat like that, but I do believe that they're deferring a lot of items that probably shouldn't be deferred, and I could go into a whole theory on that, but it has to do with getting the property on an upward spiral versus the downward spiral that you see a lot of them on.
I would also, going back to the rent roll, I mean, you ask for a current rent roll, and that'll give you a good snapshot of what people are actually paying. I always ask for delinquencies as well, which can be included in the rent roll, but it shows you how many people still owe money or how many people aren't paying their rent. So there's what their rent is, and then there's how much they're paying, and that's the delinquency, and that's a good thing to ask for as well.
Oh, and yeah, economic occupancy is as important as physical occupancy, absolutely. So I typically don't get much into the economic occupancy or even really much into the expenses or anything right off the bat. It seems to me it's much easier to get an actual rent roll and then make my analysis, and if it seems to work, get out, see the property, and get an LOI in as quickly as possible, because it is a competitive market, as anybody knows right now. And that's exactly what happened here. So we got the financials, we went out and saw the property, first look at the property. It's so important to get that. It's huge. Got an LOI in right away, and I think within 12 hours we had a deal put together. The seller was very, very probably one of the better sellers I've dealt with. Actually, was very reasonable person, was very upfront with a couple things that we needed to know, and it prevents the back and forth that can happen in negotiation. So it was a very quick deal that we came to.
Well, what were some of the things he was upfront about?
So I walked up to the property. I shook hands with the broker. He introduced me to the seller, and we hadn't walked 10 feet. And he said, just so you know, these roofs don't have a ton of life left in them yet. And I knew that too, but I had met the guy for a few seconds, and for a guy to point that kind of thing out, that tells me right there that we're going to have a good relationship going forward. That there's not going to be as many things as they're not going to try to hide things.
Yeah, good point. Yeah, so although you could also say he was pointing out the obvious to you as well.
True, and a couple things. Looking back, it's easier to see, but there were a couple things that I noticed the sellers did where they could have inflated the value or the quality of the property, and they didn't do that. For example, they had advertised to the broker who had sent to me the rehab state of the units, that roughly 90 to 95% of them were rehabbed. We later found out on our walkthroughs that 100% of them were rehabbed. And you would think if you're selling a property, you'd go in and you'd say 100% of the units are rehabbed. And these guys didn't do that. They didn't try to inflate what they had going there. So I found that to be really nice and actually pretty rare, really, amongst multifamily sellers with the market the way it is. A lot of guys you can get away with inflating what you have quite a bit.
Let's talk about the property visit, because your first step was to look at the rent roll and the financials and say, okay, I want to take this to the next level and see the property.
Right.
When you do the site visit, you meet the broker, you meet the seller there, which you don't always meet the seller on these site visits. So
no, not at all.
That was good that you got to talk with him and deal with him directly to some extent. What do you look for as you're walking around the property and through the units?
I'm looking for, does it generally represent what I had in mind? Because like you mentioned a second ago, most of the time I don't even get past the financials. I think that's most deals, well over 95%, I'm sure, but we don't get past the financials. So once we do, I've got to make a couple of assumptions. When I decide I'm going to even go look at a property, I've got to assume, okay, that the deferred maintenance is going to, be fairly minimal, or maybe I know it's going to be a large number. I'm going to have to put roofs on this thing. That's a huge number on a building like this. I'm going to have to put a parking lot in. You're going to have to assume. And the first thing you get there, even as you're pulling up, is you're going to be looking at the quality of the area, especially if you're a little bit unfamiliar. You're going to be looking at the deferred maintenance, the overall feel. But at that point, you're not going to be able to get in. You're not going to see every unit on that initial walkthrough. So you're really just getting a general idea if this property is what you had in mind,
What did you get to see when you did the walkthrough? Did you get into any of the units, any of the shared common space?
On that initial, they're fairly fully occupied there, which is always nice, I guess. So we walked the common areas, and actually, first I should say, just one of the things you pull in and you're looking at parking lot. Parking lot's a huge expense that is really, really hard to justify because you can't raise rents since you put in a new parking lot, right? So that's one that I hate. I've had to do a couple parking lots, and it always kind of irks me. It doesn't really make things look too much better, especially when they're covered in snow in Michigan. Mm-hmm. But you got to do it. It's a necessary evil. And I've bought buildings before where the parking lot had deteriorated so bad it had gone back to earth. And it's just such a frustrating capital expenditure because you don't put a new parking lot in and go in and raise rent. So the first thing I always look at is parking lot, and then the general aesthetics of the property, like we mentioned, and it did. You can tell a well upkept property from just the feel it gives off. Kind of like you can tell when you walk into a unit if it's a clean or if it feels dirty. It's somewhat untangible, but it's a feel you get.
And you get a sense of the type of tenants or residents that live at the property and how they're taking care of it as well.
Absolutely. Little tiny things that you might not notice, but you see, some properties where there might be bed sheets in place of curtains, or you might see some properties where tenants' porches are overflowing with bicycles and junk and, things along those lines.
Or you see the cardboard or the tinfoil in the windows?
I haven't seen the cardboard yet, but that would be good.
That's always a sign of something.
Or abandoned cars in the parking lot. I mean, you name it. All these things that you intuitively to look for. It's just hard to put a finger on it, but you're just taking in an overall vibe, an overall feel of the property, and that's really what that initial walkthrough is about. And then common areas. I think we did get into a vacant unit or two, but I'm really not looking at much of of the details of it at this point. I just want to get an idea together whether or not this is something that I could theoretically buy.
And common areas would be hallways, laundry room, maybe
exactly.
if there's a lobby or a leasing office, that kind of thing.
Exactly. And in a smaller building like this, they did have on-site management. So technically they had an office. It was basically a converted apartment, which we've since done away with. But that didn't matter too much. To me, it was mostly common areas. And I'm looking at things over the years I've learned, for example, entrance to a common area. A lot of buildings in Michigan have enclosed common areas, I guess, due to the weather. And the glass that you have to put on those, the glass doors and maybe the sidelight windows, those can be $3,000 a piece. So in a building like this where you have 10 or 12 of them, that's a huge expense if those don't look good. I've had to do that in the past, so I've learned to those big ticket items you start to see. So getting the overall feel of it, I could tell that this property was very close to as presented. Enough that I felt comfortable writing an LOI on it, and knowing that due diligence would cover me if there was anything wrong.
How was it presented, and what was your takeaway? I mean, was it presented as a C property that could be turned into a B property, or something else?
It was presented to me as more verbally. In fact, I don't even think when I'd seen this, I actually had seen the listing of the property yet, because we got out to look that quick. It was a phone call from a broker. He said, "We've got a property in a market I know you like. It's got strong occupancy. It's got really minimal deferred maintenance, and it's got a bunch of improvements that have been very recently done, such as unit upgrades, kitchens, baths, parking lots." He said, this property is running well. And so that was really what I went into it expecting, and that's really what I went into it seeing, which is a definite nice surprise.
Right.
One thing I was alluding to a little bit, but due diligence I can get into on this later, but I feel that, again, I mentioned earlier that relationship with brokers is so important. The last thing I ever want to do is get into a deal and back out on due diligence because it's not as presented. So that initial walkthrough, you're making this call. If I write this LOI, I fully intend to see this deal through to closing, because if I'm the guy that writes that LOI, gets it accepted, gets in a negotiation, and either starts retrading on due diligence or backs out of the deal altogether, I can pretty much kiss my relationship with this broker goodbye, which means that I can kiss a bunch of opportunities at good deals goodbye. So you're much better off to just say, I'm not going to do anything with this, or my max is X amount and the list price is X amount, so we're pretty far apart. I'm not going to write an LOI. I'd much prefer to do that, and that's all judged by that initial look at the financials. And then if you do look at the property, that initial look at the property, not done during due diligence, in my opinion.
Yeah, well, that puts a lot of emphasis and stress then on that first visit, because there are a lot of things you won't see until you actually do your physical inspection. True,
and obviously it's a huge move to go through and purchase an apartment building, and if something was not as presented that was major, it would be something I would potentially back out on. But I would never want to do that. It's kind of like insurance, right? I mean, you have insurance on your house. If you have or on your car even, if you have an accident and it's a $1,500 accident, you're going to pay that most likely out of pocket. You're not going to go to your insurance and make a claim, right? Because you're fearing the future ramifications. Same thing with due diligence. If I see something in due diligence that wasn't as expected, but I can stomach it, I'm going to just suck it up and still go through with the property, because that relationship with that broker, that future outcome, is much more important than that minor little detail. Now, if it's a major problem you see, or if you total your car, you're going to insurance. Same reason I would back out on due diligence. It's just it's the same type of logic there.
So let's talk about the LOI. You saw the property and you put together an LOI, which is a letter of intent. It's not a
Yes.
purchase agreement yet. It's not even really legally binding, other than it just says you intend to purchase this property at a certain price under these conditions.
Yep, it just basically says to the seller, do you want to dance? And we put together an LOI. When I do that, I'll make my numbers extremely conservative, because now I'm to the point where I believe this property is definitely viable. So I will go in and I will inflate expenses to the point that that I know I've never seen them that high. That would be my best case scenario if I plan for the worst, right? So I go in and I form what I think the worst possible setup is, which would be my best case scenario purchase price, and I come up with that number. That's usually going to be quite a bit off of what the seller is asking for, but I'm going to, negotiating 101, I'm going to come out with something a little bit aggressive. And that's what we did. We came out with a number, on this particular building. I believe the broker had the list price around 1.45 or 1.5 million, somewhere in there. And I came up with about 1.2 that would be an awesome deal to get this at, right? That's kind of how we start the negotiation process. And then it's just a back and forth, just like if you're buying anything from a single family to anything you do, it's a back and forth.
Okay. So when the broker brought this to you, did he have it listed like was it out there for everyone to see? Or
so
was this
it was a little bit unique, and I won't name any names I don't want to get anyone in trouble or anything, but here's what I believe happened is big picture here. The seller was 1031ing out of this, which means that he had a set time frame for when he had to have this property closed with another one lined up, and there's some pretty specific requirements there. So it was very important to the seller that this property closed as planned, that it didn't either retrade or fall out of due diligence, right? When he tells the broker that, and then the broker also always has the underlying motivation that his commission is on the line if this property doesn't close. If it doesn't close, he doesn't get paid. So I believe that having the relationship with the broker combined with the seller's need, combined with the broker knowing that we do close properties, we're I say a known closer. If we get under contract, it's much like I was just explaining, we're going to do everything in our power to see that contract through. Otherwise, I'm not even going to get under contract on our property. So a combination of all of those, I think that's what got us the first look. The broker essentially, I feel, directed us to this property, knowing that it would make it a win-win for everyone, including the seller, including us, including himself. Whereas if he just listed it on the open market, I have no doubt that it would have traded at a much, much higher price. I can get into the financials, but we bought this property at a little bit over a 10 cap, which, as you probably know, is an awesome, awesome deal, especially in this market. So what I'm saying here is the fact that the broker and the seller had this underlying motivation, I think, brought it to us at a price that is much less than what the market would have seen.
Yeah, it seems like the broker's responsibility and the seller's concern was more about getting the deal done with a buyer who they knew would go through with it, so not to upset the 1031 exchange.
Exactly. And that's where, I mentioned earlier, the relationship is so important, because had we not had that relationship, or had we in the past spoiled that relationship with that broker, we would not have been the person that got that first look at that property. We might have been 4 or 5 in, or I don't know, seen it on LoopNet. And at that point, there's a lot more variable in there for the seller, and he doesn't want that either. So everyone had a motivation to get this deal to go through. And when people have motivation, that's when things happen.
You offered 1.2.
They were our initial was around there. About 1.2.
Somewhere in the 1.2. They were asking 1.45.
Yes.
When did you start negotiating? I mean, you submitted your first LOI.
Exactly. So we submitted, and we saw the property, and got back to the office, ran a few numbers, came up with that number for the LOI, submitted that to the broker, and that was probably a mid-morning. By that afternoon, we'd gone back and forth once or twice on it, via email, via phone. It's much quicker that way, instead of revising the LOI.
Yeah, you don't want to have to rewrite and sign and scan and email the LOI like 50 times.
And I should say, I had also determined that my top line number on this building would be about 1.35 million. I don't tell anyone that, but I do have a drop dead. I'm not going above this number. It just won't. It won't justify it, knowing that I wanted to syndicate this, and we really needed a rich deal to syndicate this. So we ended up going back and forth and settling on a price at 1.3 million, which penciled out to just over a 10 cap, 10.2. And in this market, I'm excited about that, because this seemed, this is that's a very strong deal for what we're dealing with lately.
Yeah, and that's a 10 cap based on your preliminary numbers?
Based on my numbers, which were more conservative than what the broker had presented to me. So I don't really care what their expenses are because I'm going to operate it the way I'm going to operate it, short of taxes and maybe insurance like we talked about. I care about the top line, what the actual rents are, and then I inflate their expenses until it gets to a number I'm gonna work at. Very, very rarely will the seller's expenses be higher than the number I believe they're going to be. It's almost always that I have to add a factor to inflate those expenses.
Although in this case, their income might have been lower than where you knew you could get it because they had one of their units offline for on-site management.
So we had a couple little. Actually, it's funny you mentioned the income side of things, and this was just something I kind of kept in my back pocket here, but. I knew they had one unit down from management, and I knew that this was a 40-unit building. I don't believe you can justify on-site management for that. Just the way their operations were, they had done that. But I also knew, and we didn't mention this yet, but I also knew that I had a building about 8 minutes up the road that I've had for several years that the rents were about $100 to $115 a door more than what these rents were for a 2-bedroom unit. So I had this. I knew that these were below market rents, and a lot of that's the favorite line I think of brokers is that the rents are below market by $100 a door.
I don't think a broker has ever sold a property that wasn't below market rent.
Right, they're always below market, and I don't remember if they said they were here or not, but I knew that if we have a building 8 minutes up the road with over $100 higher rent per door for basically the same type of unit, we're probably below market here, at least somewhat. So I always had that in my back pocket, but I'm not going to factor that into my analysis whatsoever because that has not been proven, that has not been confirmed. I can only go off what we're actually getting today for rents. So that was one of the real hidden benefits in this deal that didn't get discussed, but that I had in my back pocket from day one of negotiation.
Great, and we'll talk about how that panned out. I want to kind of keep it in a linear progression here. You had an
Sure.
LOI, you got to a price, $1.3 million for this 40 unit. Now you have to put together a purchase agreement, purchase contract. Who did that, and how did that work out?
So we used quite a few different attorneys on this. It's a purchase agreement's a fairly important document, and my experience, I've always had typically the buyer on my deal. So typically when I'm buying, will be the one that drafts the purchase agreement. I know that some other times, I don't know what you've done, but sometimes sellers will draft it. I believe that's kind of up to the broker and up to the parties in the deal. Is that your understanding?
Well, I'll tell you how I like to do it because I've done it both ways where the attorneys draft it and that I end up hemorrhaging money because of that.
Yes, you do.
Because whichever attorney drafts it, the other one's going to have multiple changes. And before you know it, you've spent $10,000, $15,000 on attorneys going back and forth. I prefer the commercial. I think it's the Commercial Association of Real Estate, whatever, CAR. It's just sort of a template commercial apartment contract.
Oh,
and it's got usually a commercial broker can put it together for you. And it's basically just got all of the standard language in there for this type of transaction. I would have my attorney look at it, but I've learned not to have my attorney or another attorney write a contract unless it's an extraordinary type circumstance. Because why not just do it with the standard template?
Why reinvent the wheel?
Michigan? Why reinvent the wheel?
Yep.
And spend thousands of dollars to do so?
One thing that I think did help with that is that we've done this several times in the past. So I might have invented the wheel the first time, but since we're using the same attorney in a very similar deal to what we've done several times, that's basically what it was a template of past deals. And you're right, the seller could have had a lot of issues with that, but I guess luckily in our case they didn't. So we got the purchase agreement submitted, and it was a pretty smooth process. Everyone had signed the purchase agreement, which the day the seller signs kicks off your due diligence period.
Yeah. So let's talk about that because that's a huge thing. That's something that as a this is your first syndication deal.
Right.
So you're bringing investors into this, and you want to make sure that you're bringing investors who are going to put up tens of thousands of dollars into this deal. You want to make sure that you're putting them into an investment you really can believe in.
Absolutely.
So the due diligence, the physical inspection, this is very, very important. So let's talk about that. And I also want to go back because I think we skipped something.
Okay.
About the financials. You had seen the financials in a rent roll for this property. And we talked about the rent roll. We talked about the delinquency report. But there's other financials that I always like to ask for in the very beginning before I'll go look at a property. Are there other financials that you look at?
On a deal like this, I believe I got the initial rent roll, which is the most important to me, and then a very, very general. It was actually a page out of a Schedule E from the seller, from their tax return for the last couple of years, and it was that general. I didn't get much more than that prior to looking at the property, but I was much more in that mode of I think this has a lot of potential, and I don't want to sleep on this for 2 or 3 days, and potentially lose the deal.
Yeah, sure, okay. But you did get a Schedule E, which showed what the seller had reported to the IRS their expenses were for the previous year.
Right.
I want to add one thing that I always ask for, and you don't always get it, but one thing I always like to see is a trailing 12-month cash flow report. And that basically breaks down the past 12 months, month by month, what the income was in different categories, whether it be laundry, pet fees, rent income, Section 8 income, and then what the expenses were broken out, utilities, every line item expense item that you can think of. Broken out. If I can get this trailing 12, it's great because it gives me a lot of good information. So when I do go look at the property, there are things I can ask questions about. Well, I saw there was a lot of money that went into plumbing. Where are the plumbing issues on this property? So it does help to inform you. You don't always get it, but it is helpful to have.
No, I find a lot of times that will point out, initially I knew going into this that they had done, most of the units, or it turned out to be all of them, that they had done the parking lots, that they had done, they tell you all about their CapEx. They like to kind of flaunt that, but I typically haven't in the past gotten an actual cash flow report. That would be nice.
Yeah. So let's get back. So that's early on. Those are, just to make it clear, before I look at a property, when it first comes across my desk, if I'm going to take a serious look at it, I want to see a rent roll, and I'd like to see a trailing 12-month cash flow report. You don't always get that, but that's what I like to see before I take it to the next step. Now, you took it to the next step. You saw the property. You presented an LOI. You got it under contract. You went through the purchase agreement. Now we're up to the due diligence. So tell us what you do for due diligence.
So to me, due diligence is basically, let's find out everything that is wrong with the property right now, everything that is not what I thought it would be. And that can be anything from economic vacancy, tenants that are behind on rent or not paying, to problems with roofs, to problems with title, to problems with easements, to anything, so it's just it covers everything. You just want to know everything you can about this property, down to walking every single unit, which I don't know about you, Brian, but I've always done that myself. I've actually always taken at least myself and my project manager and maybe even one of our maintenance guys to walk every single unit on a property.
Yeah, absolutely. You need to walk every unit. I do like to do it myself as well, but I always make sure I've got someone who knows more than I do accompanying me.
Not only that, but I like to have two sets of eyes on it too, because there's sometimes you'll walk in and you get in a conversation with maybe a tenant or the broker while you're in the unit, and there's things you can miss. But if you have two people in there doing it, it's a lot easier to catch those little issues. And then we try to be systematic about it. So on that walkthrough, I'll usually have my project manager with me for sure, and maybe somebody else, but he'll be taking notes, and we'll rate each unit on a scale. He has it pre-printed out, so he'll circle, the kitchen's a 9, the bathroom's a 3, whatever it may be, so that we can later sit down and analyze if there was anything that jumped out at us. It's much easier than just walking a unit and trying to remember what was wrong with each given unit.
Yeah, and you won't remember unless you write it down. That's for sure.
Right.
Okay, so that's the physical inspection. You're going through every unit. You're walking the units. What else are you looking at the property?
So one of the things out here in Michigan, and it's actually a little bit funny because it ended up creating a little bit of an issue after we closed, but past experience has shown us that, well, I'll start with all of the buildings that we own, multifamily, and a lot of them I see have these self-contained units that are heating, air conditioning in one. It's a nice setup because it gives you a central air, central heat, forced air setup as opposed to the window units you see and whatnot. But they're also very expensive units and they're a little bit temperamental. So in past experience, I'd actually purchased a building and not realize that one of them was missing and one of them was parted out and several of them weren't working. So I mean, literally, we went in after closing in the past and had found out that the actual furnace wasn't in there where we assumed it was in a closet because we didn't open that door. So in a vacant unit, that's the first thing I want to check is that furnace is there, that those big ticket items that are going to be expensive. And then obviously I make a few assumptions. Otherwise, I think you'd go crazy here. But we make the assumption that in an occupied unit that they have hot water, that they do have heat, their furnace is working. You know, that there's not major we don't go under we don't inspect this like you're inspecting a house on your first homeowner purchase where we spend 2 hours in every unit. We'd never get it done. But on a vacant unit, we look a lot more into those things, I should say.
And what did you find when you were looking at the vacant units at this property?
So, well, at this particular property, there were only one or maybe two vacant units during due diligence. It might have only been one. It was pretty minimal, so there wasn't much we could do there. But keep in mind the time of year, and this will allude to a little bit what I'm going to talk about in a few minutes. But the time of year, this was, a few months back before the winter had started, and so furnaces weren't running. It was kind of that shoulder season. In the fall here, if you're not running air, you're not running heat, you don't really know if you're going to have any problems. So that was maybe a little bit of a mistake we might have made. And going forward, it really came back to it hurt a little bit. Yeah. But we normally we check all those things.
Well, you're that situation with having the central furnace, did it also include air conditioning too? So a central heat, central air?
Central heat, central air. It's a great unit. Tenants love it. It's just that they're really expensive and they're fairly temperamental. I don't think they have the lifespan of what you would see in a conventional single family house.
Yeah. And this always scares me when I see this in a property. Maybe it doesn't scare you as much, but you've got 40 units, which means you've got 40 of these central, HVAC systems, and those can add up. So what you have to look at
about $3,000 a piece to have installed.
Yeah, $3,000 a piece times 40 units. Well, now you're talking, $120,000 in capital improvements, capital expenses that you'll have to put in probably in the next 15 years.
At some point.
Yeah,
exactly.
at some point, depending on when they were installed, how old they are. What was the age of this building, and how old did these HVAC systems look?
So the catch with these systems is some of them will be fine for years. It's usually a heat exchanger that will cause a problem on them. Some of them will last for indefinitely, kind of like you've seen furnaces in old houses that can be 70 years old, and they might not be really efficient, but they're still going strong with no issues. Then you'll have other units, and for whatever reason, they won't last. They'll last 10 or 12 or 15 years. And so this building was built in 1974, and some of the units were original. Some of the units were newer, and that's pretty typical. You'll see they've had to replace certain units over time and whatnot. But in this building, more of them were older than I've seen in other buildings. I found out a little bit more about that down the road. But again, we have to assume that they're all working because there's not much we can do we definitely can't, at least I don't see justifying having a HVAC test on every single unit at $100 a door during due diligence. That'd be a $4,000, or what would that be, a $4,000 expense? Yeah. So
that can add up pretty quickly.
So I wasn't about to do that. In a way, I guess what I'm saying with due diligence is I feel you've got to really look over everything in the property as well as you can, but you also have to be willing to take a little bit of a roll of the dice. And it actually comes back to that broker relationship. One or two or even five or so HVAC units that I wasn't planning on putting in, that ultimately is not that big of an expense. It's much cheaper than if I had to pay market price for this building. if I had to pay 1.5 for this building because it got bid up or I didn't know a broker and I just found it on the open market, that would be much more expensive than a thing or two that might get missed in due diligence. So I know that might be counterintuitive, but my feeling is as long as it's a fender bender, as long as it's a little ding and it's not detrimental, I'm not going to nitpick every little thing in due diligence, and I'm sure as heck not going to retrade unless I absolutely have to, because down the road this is going to help me more and more for future deals that we can stomach a few grand here and there if we are wrong on something.
Yeah, and the physical inspection and the due diligence, it's as much an art as it is science. I mean, you have to kind of weigh a lot of those exterior factors. But going back to the HVAC systems, the fact that each unit had its own, well, yes, on the one hand, it presents an added expense because those are some big improvement dollars that you might have to put in when those units go out. But on the other hand, it typically means that both the gas and the electric are split.
Yes.
And that the tenant is paying for it.
Yes, which is always nice.
Yeah, so the tenant is paying their utility bills as opposed to you paying the gas or the electric for every unit.
Right, and that's exactly the case here. It was the only utility paid by the landlord here is water.
Yeah, water and sewer, and probably the gas to heat the domestic hot water would be my guess.
Yeah, common area lighting and common area gas.
What else did you notice during your physical inspection? What were some of the other items that you paid attention to?
Well, what we were really looking for is anytime I see or I hear that X number of units, X percent of units have been upgraded, kitchens, baths, whatnot, I'm always skeptical because just like people's opinion of what is and is not a good deal, people's opinion or sellers' opinion of what is and is not upgraded unit can vary quite a bit. So we were actually very, very pleasantly surprised to find that 100%, even more than they had advertised, 100% of these units were upgraded to a standard that I found to be close to what we would do. Maybe not all the way there. There was a couple little minor things, such as, we like a 3-tone paint in a unit. We think that does a lot for it. And these were all, one color throughout. But the actual upgrades were done consistently, and they were done fairly well. So it was actually a really nice surprise to see that. And that was a big thing on our list that we wanted to check off. I was waiting every door we opened to find a unit just in shambles that they had forgot to mention, and we just didn't find that.
Well, that's always nice to see. What did you know about the seller and how long he'd owned the property and what his strategy had been with the property?
So yeah, I always try to get a little bit of an insight even before that first look. And so I'd found out that this was a seller that had owned the property since 1988. So he had been operating it fairly successfully for a long time based on the numbers I had seen. I also found out they were a little bit bigger of a seller. They had a couple thousand units in the area, which was also surprising to me because the way they did their financials was all handwritten. They didn't own a computer or anything. So the rent roll was handwritten, and every updated rent roll I got was handwritten. Everything was done manually, which was, I've never seen it before. It was amazing. Especially since they're managing several thousand units at multiple properties this way.
Wow, you'd have to hire someone full-time to just handwrite everything out.
You know what I said is maybe that's why they needed an on-site manager. She just writes rent rolls all day.
Yeah. Wow. Okay.
But it worked for them. They had a system and that worked. So I can't necessarily complain that that's what we were working with. We were presented with everything we asked for.
Yeah. Usually when I see that type of system, it indicates to me mom and pop operation. They're doing all the repairs themselves, and there's probably going to be a lot of deferred maintenance. In this case, it seems like that was not necessarily true.
I was absolutely expecting the exact same, and we didn't find that at all. So just kind of a little bit amazing.
Yeah, wow.
Especially on that scale that they overall portfolio was run that way.
So there's the physical inspection, which we've talked about, and then there's the rest of the due diligence. Can you talk about that and what kind of due diligence you did beyond the physical inspection?
So The physical inspection, when I first started doing this, I used to dread walking all the units. I thought how much of a pain that would be. That's actually not bad at all, I don't find. What I really dread doing, but it's just such a necessary part, is a lease audit. So going through every single lease for that property and making sure that that matches that rent roll. Because remember, I've based almost every number I've got, I've based off that rent roll that they provided and then taken an expense ratio off of there and whatnot. So if they are somehow falsifying that number, or maybe they misrepresented somehow that number in that rent roll, we've got a problem. So I go through every single lease for the property and make sure that the rent is matching what they put on the rent roll, and make sure that the security deposit matches what they put down, so that we don't have a dispute down the road about security deposits at closing.
So typically when you have a lot of handwritten rent rolls and that, you find a lot of mistakes or errors or inconsistencies. What did you find when you did that?
We did actually. We found quite a few minor inconsistencies. It wasn't a major issue, but what we had found was that they had been raising rents on tenants, and they were either doing it verbally or without a documentation. So some of the longer term tenants in there, the amount they were actually paying on the rent roll was higher than the lease, which is exactly the kind of thing I'm trying to catch. So it initially drew up a little bit of a red flag. And we're talking, the largest difference might have been $50 or $60. It wasn't detrimental, but it was enough that it could make a difference. So that actually caused me to go back to the broker who went to the seller to get explanation. And we actually verified it with bank deposits, that exactly what they had been doing. They'd been raising rents and either not documenting it, or for whatever reason, the lease didn't reflect that.
Well, so then that can cause a problem for you when you take over, because the tenant could refer back to the lease and say, well, now I'm just going to pay what the lease says.
Exactly. So then we had to make another judgment call, and this would be really easy if it was all black and white. So I actually went to our attorney for this one of the attorneys that we used. We used a total of 3 different attorneys on this deal. But I went to the attorney that I was working with for the purchase agreement and whatnot, and said, this is what we found, what are our options? And she came back. This is one reason I like her so much. She came back with, you have 3 choices here. 1, you can demand that the seller go reduce the price based on the current rent, basically take a real aggressive approach, demand a reduced price due to the risk you're taking with assuming these lower rents and so forth. Number 2, you can ask the seller to put in escrow the amount that could be the difference in rents going forward. Or number 3, you can assume the risk, and your risk being, if you look at it, what your real risk is if the tenant goes to court, or if the tenant doesn't pay the amount of rent that the rent roll says they should be paying and pays what the lease says or whatever else, you would have to take that tenant to court to evict them, and then you would have this dispute in court over what the rent amount should be. And she said, really, your biggest risk here is a few dollars on a few units. So her recommendation was to take basically the do nothing approach, and if there was a problem, know that we were risking a few dollars per unit, which is what we did, and it ended up not being an issue. At that point, a little bit of that judgment call was based on how honest, upfront, open the seller was with everything. And these guys have been hands down awesome, to the point where even a week ago, they brought us a check that should have been given to us. They dropped it at my office. That's how good these people were. And we had that feeling going through that. So we had to take a little bit of a flyer on that one.
So one of the things you mentioned was looking at the bank statements. So I take it that you asked for checking statements as part of your due diligence so that you could verify the income and expenses?
Right. So I don't necessarily feel that we always need an actual bank statement, especially if we're getting tax return documents and whatnot. But in this case, we asked to verify because of what seemed to be an issue with the rents. We're talking, this is a fairly minor. We're probably talking about a total of maybe $250 out of a $20,000+ rent roll. So it wasn't huge, but it was enough that it was just, I wanted to verify that we were on the same page. And a deposit statement showed that pretty closely, especially going back several months. So it was really a non-event, but it's just something that comes up, and it could have been much worse. If we hadn't done a lease audit, we would have never known.
What were some of the other items you asked for during the due diligence period?
We ask for all kinds of stuff. We just have a huge due diligence checklist that we send over that says send us utility bills for 3 years, send us tax bills for 3 years, send us insurance statements, send us all your CapEx, send us any kind of management payroll expenses you have, how much you paying for lawn, all your laundry contracts, all your snow removal contracts. I mean, it goes on and on and on. And the seller actually sent back. I find that we don't typically get every single thing back, but they sent back almost all of it to us. It was fairly straightforward.
And then at the same time, you're starting to figure out where the money is going to come from. So you're talking to lenders, getting an idea of who's got an appetite for this type of property, and then also beginning to think about third-party reports that the lender's going to require. Talk about that a little bit, please.
So if you're referring to the financing side of it, it's funny how it's gotten easier and easier, but I probably could have financed this deal at 5 different banks that I have good relationships with. I mean, it's pretty much who do you want to bring the deal to, or do you want these banks to compete amongst themselves? So I brought this particular deal to a bank that I knew was fairly local, that I had a really, really good relationship with, and I knew I could use that relationship to get the best possible terms on the loan without putting a bunch of banks up against each other, which that creates another issue. So it really wasn't a hard deal to finance from a bank standpoint. In fact, I think we had an approval here within a week or so. I basically had a verbal approval from the VP of commercial lending within probably a day or two of bringing him the deal. But the deal was very, very strong. They're looking at debt service coverage ratio, DSCR, and we're talking their minimum is 1.25, I believe, and we're talking this deal was showing about a 1.75 or 1.8. It was just an easy deal to bring to them.
Yeah, and that's basically what portion of your income, what's the ratio of how your income is going to cover your mortgage payment?
Right, your net operating income divided by your mortgage payment. And that's a big, big factor, probably the most important factor I've found for commercial lenders. So because of the relationship we had with that bank, with that lender, and because of how strong the deal was, we were able to line up some really, really good financing on it. We ended up with a rate at 4.25, 20-year term, 7-year balloon, and 80% financing on the deal. So that's pretty good numbers.
Wow. Okay. So let's go over those terms. So you got an interest rate of 4.25%.
Yep.
Amortized over 20 years, right?
Yes.
So it's basically you're paying it. If you were to pay it, principal and interest for 20 years, after 20 years, you'd own it free and clear.
Right.
But as is typical with this type of commercial loan, there's a balloon payment that a lot of times comes due in 5 years. But in your case, you were able to extend it out to 7 years.
Right. It's just I always like to have as many options as possible. And obviously, the longer term you're locked in at that rate, the longer term before you have to make a refinance or a sale decision, the more options you have. Even if we don't use it, it's nice to have that option.
Yeah. And not knowing how quickly rates will rise, having that longer period gives you more time to kind of ride out whatever ebb and flow there is in interest rates.
Absolutely. And at 4.25, your amortization schedule looks really, really good. There's a lot of principal pay down at a lower rate like that. So, especially on a 20-year term.
So the bank looked at this deal, and as a commercial lender, they're kind of your partners in the deal in a lot of ways. So they're doing their own underwriting.
Right.
Obviously, the debt coverage ratio is very important to them, but they also want to see historical income and expenses. How did their numbers turn out compared to yours?
I believe they mostly looked at the same things we looked at, definitely on a lighter level. They looked at they tend to care a lot about occupancy and historical occupancy, or the stability of the building. So they're looking at that. They're looking at the rent rolls. They're looking at the actual expenses, which actually probably benefits me because I'm inflating those expenses on my numbers. So the deal actually probably looks a little bit better to the bank even than it looks to us.
Here's the thing. You get to this point where you haven't really spent that much money up to this point.
Right.
You paid your lawyers to help you out with the contract. Maybe you hired some people to help you with the physical inspection, but you probably haven't committed too much of your own money at this point. Any money you have spent is coming out of your pocket up to this point.
Absolutely. Yep.
Now you get to this point with the bank where you have to pull the trigger. And that is commit. That means basically commit even more money to the deal. You're going to have to pay. A lot of times the banks want some money up front to start, to cover expenses for third-party reports. At what point were you willing to pull that trigger, and how much money did you have to commit at that point?
Well, by the time I'd gone to the bank, but really by the time that I had a purchase agreement, I was willing to pull the trigger. I've already committed to the deal. And now, granted, if something was a catastrophe during due diligence, I would have backed out and just chalked it up as a loss for whatever I had into it.
You might have been out a couple $1,000s at that point.
Right, but you're going to be a few $1,000s, even on a smaller deal like this. You're going to be appraisals, environmental, loan commitment fees. You're going to, attorney fees. You're going to be a few grand into this deal easily, right up front. And then it gets into more kind of next step.
But you can defer having to commit that money until after you're reasonably certain after looking at the due diligence and the physical inspection.
Right.
I mean, because you don't have to commit to those third-party reports until you say, okay, I've done the physical inspection, I've done my due diligence, I'm confident enough in this deal that I am willing to spend this money at this point.
Right. And on this particular deal, because of the seller's 1031 needs, one of the catches was to not hold up unwritten requests was to not hold up the loan approval process as much as possible. So I was actually working on the loan approval process at the same time that I was doing due diligence. I might have even, I don't recall exactly, but I may have even paid those fees before physical walkthroughs. Knowing that there was a little bit of a risk there. Those fees were definitely paid prior to the completion of my 30-day due diligence. Right. Somewhere in that process where I still could have backed out and lost those fees.
Yeah, so you had high confidence that this deal was going to happen, and you were willing to commit the money sooner rather than later.
Right, in order to move things along.
So, and I think this is for a lot of our listeners out there who maybe haven't done a deal like this and are looking to do it. It's important to realize that at some point you have to pony up some money, and you can't just do it with no money down. You're going to have to start paying some money. Let's talk about what some of those expenses are in the beginning stages here. Third-party reports,
first
commitments
and
from
biggest
banks.
Is the day you sign that contract, you've got an earnest money deposit of typically $25,000 or $50,000, even on this size property. I think ours was $25,000. So you've got to cut a check for an earnest money deposit. That, granted, if you back out during due diligence or financing falls through, it's going to be refundable. But once those contingencies are relieved, you're on the hook for that. You've got your
but that is money. It's not just you write a check and it sits in a desk somewhere. That money, that check is cashed and it goes into an escrow account at a title company.
That's at a title company, and that needs to be there.
Yeah, so that's $25,000 that you'd get back, or it gets applied to the purchase price, but it's $25,000 that you're committing out of your bank account right up front.
Exactly, and that needs to happen basically the day you sign the contract. And I've seen it. I've done one as high as 50 or 75,000 before. You need to have a little bit of skin in the game, just like you would with even a single family purchase. But then you've got appraisals, you've got environmental, you've got, at least in my case, we were able to pull a few favors and have a lot of our vendors we use come out and do, for example, roof inspections. Plumbing inspections, things like that. But a lot of times you've got to pay during your due diligence to have some of those, maybe it's a boiler test or some of those tests done. So there's expenses there. There's attorney's fees are starting to pile up. Every time you pick up that phone to call your attorney, that's going to cost you.
Yeah. So how much would you say you've committed at this point?
I know that overall, I had out of pocket about $37,000 for this deal in the end. Now that includes PPM costs and all those loan commitment fees. So out of pocket, I had about $37,000 somewhere in there.
Okay. And that's not bad at all if it includes your private placement memorandum.
Right. So the private placement, and I should say some of those bills from the attorneys didn't come in until after the fact, so they didn't come out of pocket, but I had committed to them. So there might have been another $5,000 or $6,000 because let's say an attorney bills you a month later. We've already close the deal. So I had a few of those trickle in, but we were somewhere in that range, and that came at various stages through due diligence, and then even up until closing.
Yeah, and all that gets reimbursed back to you when you do close,
right?
And it comes out of the money you raised to do the deal. But
Right.
It's still $37,000 that you had to have on hand in order to
Yes.
be able to afford to go through with this deal.
Right, exactly. And at some point, all of that is committed. Once you close that due diligence, you're essentially you're 37,000 into this deal, which is a little bit of a concern, because if you don't, for whatever reason, you don't raise the down payment funds, you don't have the down payment funds ready to go from another source, maybe your offering doesn't go well, you're on the hook for that amount plus whatever bills are going to roll in for services you committed to.
Yeah. So now we get to the fun part, which is raising the money. Something that I've done several, many times actually, and this was your first syndication. The bank was giving you an 80% loan to value loan.
Right.
You were coming up with the other 20% equity toward the property, but then you also have closing costs and
Right.
and the $37,000 that we just mentioned.
Right.
All that needs to get reimbursed to you. So you're actually probably raising an additional 5 to 10% on top of the 20% equity.
Yeah, exactly. So we had a down payment. First of all, 80% financing is awesome, and if the deal's cash flow supports it, like this one did, I mean that's a little bit of leverage really helps your returns, especially when it's a safe leverage, like in this mode where there was quite a bit of excess cash flow to support it. So we had a down payment requirement of $260,000. I set out initially, probably a little bit on the light side, but I set out initially to raise $300,000, knowing that that would get our down payment, our closing costs covered, but also knowing that at closing you're going to receive some prorated rent, so your closing costs can be a little bit reduced based on what kind of credits you're going to get at closing. In hindsight, I probably should have raised a few more dollars to start with a few more reserves, but it worked out pretty well.
Let's break this down into numbers. The bank was putting up 80% of the 1.3 purchase price, 1.3 million.
Yep.
Without pulling out my calculator here, what did that come out to?
The bank financed $1,040,000.
$1,040,000. You were coming up with another
$260,000,
which brought you to 1.3.
Yep.
But you raised $40,000 on top of that to cover all the expenses, right?
Right.
Okay, so $300,000 altogether.
Right. And now I had to come up with that number before I maybe knew what all these expenses were too. Especially one thing that's sometimes tough to calculate is, and I've had this one bite me in the past, but is prorated taxes. I had a few deals ago where I didn't realize until the day before closing that I was actually going to have to escrow taxes and pre-fund that escrow account. So that was an $80,000 swing that I didn't see before closing. This one I knew I wasn't escrowing taxes, so it was a little bit easier. But there are some numbers that on when you're dealing in the millions, these numbers can swing quite a bit. So you want to have a little bit of cushion there too.
Yeah. Proration of property taxes that's a real hot potato there. Because depending on where you are, even in Michigan, it's done very differently in the Detroit area than it is on the west side of the state.
And this city is done differently than most of the cities I invest in a few miles away. Whereas the winter tax bill here is your big bill, which meant that it wasn't billed yet during closing. And so the summer tax bill that we were prorating most of it was much, much less, which made your prorations less. Yeah. So it's exactly opposite of a lot of other cities. It's just interesting.
Yeah, I'd imagine every state and every city has their way of doing it. But basically what it comes down to is, a certain amount of money gets paid toward property taxes every year. When a property is sold, how do you determine how much in property tax is paid of that property tax for the year is paid by the buyer versus the seller? Well, it always depends on when the property changes hands. But then some states or some areas, they prorate it based on the calendar year. Some areas prorate it in arrears. Some states, I keep saying states, some areas prorate it as if it was paid in the future. So that does mean a big swing to you. Sometimes it means some money in your pocket when you buy. to go toward property taxes. Sometimes it means a big chunk of money out of your pocket to go to the seller.
Right.
And it's really important. And this is, at the end of the day, it's very important to get this straight up front. So it would be that how the property tax is prorated needs to be in the LOI. And if not in the LOI, definitely in the purchase agreement. And that's where the lawyer, if you're going to have your lawyer look at anything in the purchase agreement, have them look at how the property taxes are prorated, and have that conversation early on, because it can really come back to surprise you.
Yep. I've learned that the hard way.
Yeah. Another thing that you have to budget for is insurance.
Yes.
Some lenders and even some insurance companies want the full year to be paid in advance.
In fact, I've seen that almost every time. It's if you want to take insurance over a quarter or monthly basis, you're going to pay a premium to do that. So we typically do have to upfront that insurance cost.
Yeah, I have my analyzing software that I use to analyze the deal. But then I have a completely separate spreadsheet where I break out all of the closing costs and the due diligence costs and what, basically, property tax proration, insurance costs up front. Sometimes the banks want capital reserves to be in place when you buy. So you might have to come in with an extra couple $100,000, depending on the size of the deal, to fund your capital reserves account. It just, you need to know what your lender's going to require. And you need to know what your contract requires as well.
Right.
So let's get back to the funds raised. You determined, after looking at all the numbers, that you needed to raise $300,000.
Right. I was trying to raise as minimal amount as possible to therefore give as much equity as possible to the investors. It's a double-edged sword. You don't want to raise $400,000 when you only need $3, but you definitely don't want to raise $250 when you need $3. So I felt that that was going to give us a safe starting point. And it was okay. In hindsight, I probably should have raised, another $20,000, $30,000 for a little bit more cushion, but it all worked out pretty well.
That $20,000, $30,000 would have been cushioned for what? Immediate capital improvements or what?
So no, since there was minimal capital improvement, it was actually a little bit easier here. But we're operating with on this particular property. The plan was, and we are operating with a $20,000 reserve, and so we started with not as much of that as we would have normally started with, which means it has just been built over cash flow from the first couple months. It's just you're basically picking a number, and for me, I pick a number on every property based on not only how much I know is coming, but how much I suspect could come.
Now, up to this point, you'd always, correct me if I'm wrong, but I seem to remember from our previous conversation, you'd always basically purchased with your own money.
Always, yes.
Is this the first time you'd brought in other investors to your deal?
Yeah, I have one other multifamily deal where I 50-50 partner with another investor, but it was much different structure. That's essentially you raise half, I raise half, we're done. And then I partner with investors on single family all the time, as far as they'll bring in debt to the deal, short-term debt, and receive a payoff as we refinance the deal out. But yeah, this was definitely my first syndication, and definitely my first time bringing multiple investors in to one deal to all participate as equity partners.
So are you an equity partner as well? Or
Yes.
Did you bring money into the deal as well?
So on this particular deal, I didn't bring any cash of my own. I initially contributed cash, but I recouped that cash as through closing and whatnot. So of the $300,000 raised, I brought zero cash in to the deal. I raised all those funds from the investors, which purchased equity in the deal.
Right. And some people might say, well, if you don't have any skin in the game, why should you get any equity in the deal? Well, the answer to that is obviously based on our conversation, you had a lot of skin in the game. You found the deal, you analyzed the deal, you did the inspections, you put all the pieces together, you fronted your own money to make the deal happen.
Right.
That's what entitles you to be able to use other people's money to finish the deal.
I actually love that argument because if I brought the deal to an investor and that was their response, that helps everybody, because that tells me they're not probably the right investor for the deal. Because the biggest thing is, besides bringing the cash initially, besides the relationships, the deal wouldn't have even been born if it weren't for the relationships that we've built with the reputation over the years. The even down to the loan, the rate, the terms we got, that wouldn't have been given to any person right off the street. That was built over years and years of relationships. But more importantly than anything is that I have the most skin in the game to make sure the deal goes through without anybody else, without any capital in, because that $1,440,000 note that we have is personally guaranteed by myself and no one else. And it does not get any more skin in the game than being on the hook for the entire note if something fell apart, as opposed to an initial investment. So I actually do have a lot of skin in the game. It just wasn't actual cash put into it at the time.
Right. Yeah. There's a lot of other currency besides cash that goes into doing these types of deals. You have a full recourse loan with the bank, with the local bank, which basically means if anything goes wrong, they can come after you for whatever money they've lent.
Not only this, but also personally for anything else that I've built over the years. So I've all kinds of incentive to make sure that this deal performs and performs well.
So why syndication? Why did you syndicate? And tell us about the process.
All right. So in the past, I've done every deal I've done, and I've done larger deals than this as well, that I've done simply on my own with my own funds, or raised my own funds through sell of property, refinance to do it without other investors. But a while back, I realized that the big picture thinking and where I really see investing going is I'd like to get the number of units into potentially the thousands or tens of thousands. And at some point, investing just your own capital and keeping everything for yourself, it's a very limiting philosophy. And eventually, you're going to cap out on what you can grow. There's only so much capital I can raise out of my own funds. So syndication is, if you look at any large apartment building, there's a good chance that it's syndication that put that together. And so I realized that is the way to grow the dream that I have of running a large number of units and the business as I see it is through starting to have other investor participation. So that this deal, even though it was fairly on the small side for a syndication, it seemed to me like a great opportunity to get in and get my feet wet and try this out, especially because it was such a strong deal, which I found was extremely important to syndicate. It's one thing if you do a deal that's marginal on your own and you muddle through it, but if you do a deal, if you get into a deal that's a syndication and it's not strong, you're going to have not only your other investors to answer to, but the performance is going to look much worse because everyone's trying to take a piece of a very, very small pie.
Now, you had never syndicated before, so this was your first one. How did you even begin to figure out the process of syndication? Because it's governed by the SEC. There's strict rules you have to follow.
Absolutely. So I've known for a while this is the way that you need to go. So I've researched, I've read about it, I've met with syndication attorneys. I've even had a couple deals that I had written LOIs on where my intention was to syndicate it. So I'd run the numbers as if I were going to present them to the investors, and for whatever reason, those deals never got off the ground. So with this one, I had a little bit of a basis, but I definitely didn't know everything that there was to know. I still don't know everything there is to know about it. So I went to people who were smarter than me. So I went to different attorneys, different investors, and picked their brains on how they'd done their syndications before, to make sure that there wasn't anything I was missing.
So talk about raising the money. How did you work with your investors? How did you talk with your investors, broach the subject of investing you, and get them to commit some funds?
So once I had the deal together and I had a good picture of what the numbers would be, that's the next step, is raising the funds. So I had to go out and find, it's not just investors that will have the money to do it, but it's got to be the right investor for the deal, because that investor that works with me on a single family property where we're repaying them every 6 months or 8 months, and they're recouping their capital, a lot of times that might not be the same investor that wants to participate in a deal that could have a 4, 5, 6 year plus hold. So it's actually a different pool of people you're going to.
You're looking for an equity investor, not a debt investor.
Exactly.
So,
exactly.
Yeah, a debt investor being someone who will loan you money at a certain interest rate and expect to be paid back a steady amount, versus an equity investor who's going to ride the ups and downs of cash flow with you.
Exactly. And it's a really a different mindset from the investor standpoint. And I can see the logic going either which way. But the investor you're looking for really has to be in it for the long term and has to understand that the way that these investments perform is sometimes a deferred gratification strategy. That's definitely not for everybody. So it was a different pool of people that we started with. And those people had come from relationships over the past years, from being in the business. They had come from people who had reached out to me through different podcasts. And as a matter of fact, some from even this podcast that I developed a relationship prior to this deal, that people that had seen the strategy that we used, and in a way, they're investing with you as much as they're investing in you. They believe, I found that the people that are in this deal with me believed in my approach to things even as much as they believed in the deal itself. And once, getting through it, I found that it was actually a lot easier to raise the money than I ever thought it would be. I think because of those things, a strong deal and a strong background for performing with deals.
What kind of techniques did you use to describe the deal and then close the deal with them?
So the first thing I did was I once I knew what the numbers were, I put those down. I broke that out. And, what I did is if you're shaping a proposal to these to anybody who's going to participate in the deal with you, they want to know what their return is going to be. That's the bottom line. And the market, I think, demands a certain rate of return. So whether that be 12 or 13% or 16 or whatever that is. So what I did is I played with the numbers enough to figure out what would be the investor's percentage of the deal as a whole, and whatever's left over is what's left for me as the sponsor. So what would that number be that would make the return sufficient for the investors, but would also make the deal worthwhile enough that I would take a part of it as well. This pie has to be divided up quite a few ways. So luckily, this being such a strong deal, the way it worked out was 50% of the deal to the investors and the sponsor keeping 50. It's a fairly strong override, and actually, there were a couple investors I pitched it to that I got a little bit of kickback from, and I'm okay with that. I use the analogy of we sometimes will purchase a single family house from a wholesaler, and I never care. I to this day, I say this all the time. I don't care how much. I wish that wholesaler would make more than I would make in the deal. As long as I make what I need to make, the more they make just means that they're going to have more to come back and bring me more deals later, right? So that was the logic we used.
Yeah, I deal with this too. Some investors, they get really hung up on the equity portion. Like what's your slice of the pie versus their slice of the pie? But really what should be more important to the investor is what are the projected returns? What's the cash on cash return and the annualized return that they're going to receive?
Exactly. And that's what we did. So we penciled out the breakdown after playing with the numbers enough that it would pencil out to our projected returns on this deal. We're in the 16 to 18% range, which is, a very, very good rate of return. And I've also, any number I'm going to run it conservatively. So they might have penciled out to higher and I might have proposed that. But either way, the investors that I then presented the deal to, it was actually amazing that how I maybe because the deal was strong enough, or maybe because the relationship I had built with them, but how quickly the deal filled up. So we can cover, I'm sure, all the PPM side of it, but essentially,
let's talk about the returns that you projected. Now, you can't promise returns.
Right. You cannot promise returns, and you get yourself into a lot of trouble SEC wise by going out and guaranteeing or promising returns. So it's all a projection. This is all what I think this deal may make based on the numbers that I'm working with and past experience.
So tell me, what did you tell your investors? What did you project their returns would be on this deal?
So what I did myself was I went in and with all the numbers I ran, with the override I decided to take, I actually projected out that giving 50% equity away would pencil out to a return for the investors of just over 20%. So I've always been of the school of thought that you'd like to under-promise and over-deliver. So I went ahead and backed that 20% out for a little bit of cap. And
when you say 20%, is that 20% annualized after you sell the property? And
annualized. Now, that's not going to be a cash flow each year or distribution, but that's going to be really three components. That return's going to have first of all, your cash flow that gets for us distributed quarterly. It was a portion of it. I think that was roughly around 8 or so percent of that.
So based on, and I think that's important to me, at least when I talk to my investors, is based on the cash flow and the distributions that you're going to receive every year. Your cash on cash return is going to be, in this case, it sounds like roughly 8% a year.
Yeah, ours, it's really a 3 component. So, and I actually presented this exactly as I had, maybe even a little bit too in the weeds with the numbers, but I presented this to the investors exactly as I had figured it. So the cash on cash for them worked out to, from distributions, about 8%. Another portion, which is my favorite, is the principal pay down portion, especially with this great rate we had lined up, and the somewhat higher leverage than normal. With the 80% financing, that worked out to somewhere in the 6.5% range. And you can't use the word guaranteed, but as long as you make your mortgage payments, you're getting that portion of the return, which is really nice. That's my favorite. Mm-hmm. that one's happening, right?
Yeah, and let's stop there. Principal pay down is basically every month you're paying your principal and interest on the loan. The principal is going towards the paying down what you owe on the loan, and you in this case you were calculating that return at 6.5% every year.
It was somewhere in that, and I'm sure I could pull it up, but it was somewhere in that ballpark of around 6.5%. Mm-hmm.
And of course,
over a 5-year hold is what I projected this all for.
Do not realize that return until you either do a cash out refinance or sell the property. So It is a deferred return, but it is something that you're building up every year.
Absolutely. Yeah, and a very nice, secure way to build it up.
Yeah. And then the third component?
The third component is whatever value you can add in the building. And to me, this is the biggest wild card because there's no way of knowing what's actually going to happen in the future. But I looked at a few things going into this, and rent growth, I feel, has been extremely strong for the past 5-6 years. I don't feel like it's sustainable. If it was, that would be great. But I definitely am not going to base my projections on that. But I did look at what I thought we could do with expenses on the property and with whatever market rent growth, not market rent growth, but whatever undervalued rent growth might have been there. So I mentioned the property I have up the road where rents are a little over $100 a door higher. That's about 16%. That's a huge number. So I'm not going to bank on getting even that much of a rent growth into this property in case there's something I'm missing. But I do think there is a little bit of rent growth to be had, even if the market stays flat. So what I came up with, I think a very, very conservative approach, is I figured in a 7.5% NOI increase, which would be a combination of either rent growth on your top line and or decreasing expenses on the bottom line. So overall, I figured 7.5% NOI increase over a 5-year hold, which is pencils out to a 1.5% a year.
I feel like that's a very conservative assumption there.
And if I miss and it's way higher than that, then it just looks better for everyone. So in theory, I could have raised the rent 16% day one and gone to market rent, and we all know that's not actually possible, but in theory, that's where I think the rents are. So anything above 1.5% a year NOI growth, and we're going to be looking better than projected. But even with that penciled out to overall return of somewhere around the 7% range because of that. So that worked out to, if you do the math, just over 20, 21, somewhere in there return. So what I did is, in another effort to be conservative, is I went ahead and backed that out and said there's always things that happen that I don't know are going to happen. The unknown unknowns, right? Those are the scariest. So I just went ahead and backed out a few percent for that, just for the sake of I don't know what's going to go wrong, but something will. And so that's where I came up with that 16 to 18% range, which I think we should have no problem at all hitting on this.
So the 16 to 18% range, that would be an annualized return. So if you sell this property in 7 years.
And I did it over 5 hold, even though we do have another conservative measure was I penciled it out over 5, even though we plan for we have a 7-year option to hold.
So you did a 5-year assumption. If you sell at the end of 5 years, take the profit, take the principal pay down, take all the cash flow and cash on cash return that the investor has been receiving every year, and you divide that by 5 years, that gives you a 16 to 18% annualized return.
Right. And one thing I didn't touch on real quick to step back just a touch is the NOI growth. You're growing the NOI, but that's growing the building value. So by growing NOI 1%, you're going to raise 1.5% a year. You're going to raise the building value by a multiple of that because of how these building values are figured with a cap rate. So maybe a multiple of 9 times that or 10 times that. based on how much you grow your NOI.
Yeah, you force appreciation on the property by increasing the NOI,
exactly.
Which basically means increasing your income and decreasing your expenses.
Yep.
And that NOI for the year gets divided by the cap rate for the area, and that pretty much determines what the value of that property is.
Exactly.
Let's get back to the syndication here. Tell me a little bit about doing the PPM process, what that is, and how your process worked.
So the way we did it is once we had the returns figured out and we knew we were going to try to raise that money, we had decided on a breakdown of raising $300,000 via $50,000 minimum shares, which penciled out to 8.33% per $50,000 share. So we knew we were going to raise that. We went to
so you made this, the minimum investment was $50,000.
Yes, exactly, 50,000. And so we went to actually two different attorneys. We found a PPM company, which I'm sure I can share. It was called Reg D Resources out of Colorado, and they're strictly PPM attorneys, and they were fairly inexpensive. We paid, I believe it was $6,500 total to do a PPM with them to get the actuals in there. Whereas the attorney back home that I'd been talking with over the years would have been more in the $12,000 to $15,000 range, which I think is fairly common.
Yeah, that's what it is.
The downside with using someone out of state was that they would not do any of the state filings for us, and they would not do any of the operating agreement or anything that was state based. And they also didn't do filings for whatever reason with other states that we had investors. So it created a little bit more work on our part, but my goal was to keep these formation costs down because eventually that's a drag on your overall investment and the return for everyone. So by doing it this route, we really had two attorneys in the deal, and the local attorney doing the operating agreement and the PPM attorney doing the private placement memorandum. We went ahead and got in under we offered this under what's called a Regulation D, a 506B exemption, which allowed us to have investors that were both accredited and non-accredited up to a certain number, which I believe was 35. And they could be from anywhere in the United States. So it gave us a fair amount of leeway in where we would raise those funds. And there were certain keys to that, which we were advised we couldn't advertise publicly for the deal, things like that. But we got the PPM going. We worked back and forth. I say we, it was mostly just myself and a little bit of help from the office. But I worked back and forth with the attorneys drafting the PPM and the attorney locally drafting the operating agreement, because these documents need to reference each other and need to make sure that they're on the same page. And we were able to produce a document, and our PPM document, if you've ever seen one, it's hundreds of pages. Ours was 165 pages, it looks like. But it basically breaks down what the risks are in a deal, a snapshot of the deal, has an operating agreement in there, a subscription agreement. All these things are part of the PPM. So once we were able to get that PPM complete, I was able to actually go out to investors, and I had a list of people that I'd been talking with either over years or even months, or just people that I thought might have an idea. I was able to present that PPM to these investors along with a little bit of explanation for maybe save them from reading initially through 164 pages, but basically get the deal out. And to my surprise, we ended up funding the deal within about a day and a half of having the PPM out. It was extremely quick. We had, I guess, the right pool of investors we went to. Some went for it, some didn't, but I was fairly slow to roll the deal out. I didn't want to go to every person I knew and then oversubscribe it. And I felt like having to go back to them and say, sorry, there's no more room. I felt that would create a little bit of maybe animosity and maybe hurt future deals that I might want to work with these investors on. So we slowly rolled it out, and we're actually able to subscribe the deal very, very quickly. And then it was just a point of really just getting subscription agreements and checks sent in.
Nice, smooth process for your first syndication. Now, the PPM, again, is a private placement memorandum, and it's required by the SEC, and it basically contains all kinds of warnings. It takes a very brave investor to read through the PPM and still do the deal, because it basically says you have every chance, there's every chance that you're going to lose your money. And here are the reasons why.
It's just like a prospectus for a stock you would read, or for a mutual fund. It could be basically the same idea.
Yeah, it's kind of like the pharmaceutical companies when they advertise their drugs on TV. It's like it may cause hemorrhaging and death.
Right.
That's basically what a PPM is.
Yeah.
But it's required a private placement memorandum. The operating agreement is an important part of the package for the investors, so they see how the equity is split, and what were to happen if you get hit by a bus, and who's going to take charge after that, how the asset is disposed of. These are things included in the operating agreement. Then you have the subscription package, which is what the investor actually signs and includes with their check when they commit their funds.
Yep.
It sounds like you were able to raise money very quickly. Did every investor who said they were going to be in, did they invest, or did you have anyone back out?
No, they did. In fact, I almost couldn't get the last investor that participated in the deal. He almost didn't participate because there was only one share left for about $50,000 for a $50,000 share, and he wanted more of the deal than that, or he didn't feel that it was worth his while. He ended up participating anyways, but it was a little bit ironic because I thought it might be more difficult to raise the money, and I almost didn't have enough of the deal to let this last investor in.
Yeah, and going into this process, were you concerned about raising the money? Did you have any doubts that you'd be able to raise $300,000?
Yeah, I had every doubt in the world. I had it's been a mental block for me probably forever. Even single family raising private money. I had all kinds of doubts. In fact, I had a backup plan that I would go through and purchase the deal on my own if I couldn't raise the money. So I had intended that to no matter what purchase the deal, it would just be a real shame to invest all the time, effort, and money into the PPM process to have it not go through. So it was definitely a nice reassurance when everyone joined the deal.
So that's the syndication part. Congratulations on raising that money and doing it so quickly and efficiently. Take us through the rest of the process, all the way through the closing.
So once the funds were raised, it was really just a wait for the closing type scenario. We'd gotten through the due diligence, everything checked out virtually as planned. We had some ideas for a couple tweaks that we thought could improve the property, as we always like to do right after we close, but it was basically a waiting game. Prior to closing, we got the initial HUD, or the documents that tell you what you need to bring to closing, verified those with attorneys to make sure prorations were correct. And actually we had a lot of back and forth on prorations because of the way they were collecting some rents. There was actually quite a bit of revision to those closing documents. But we got that all resolved, went to the closing, took over, and then it's really that's when the work starts, because now you've signed on the dotted line, and this just happened for us to be the day before Thanksgiving holiday. So we it's a little bit funny, but we closed on the deal, and at the closing, the sellers told me, well, our on-site staff, the resident manager and the maintenance personnel, there's a maintenance man and a helper, quite a bit of staff for this building. They said they're not really totally sure what's going on here. We've told them we were selling the building, but we didn't give them really any firm details. So basically, we were new owners of the building, and we had to go down and tell these people that they probably weren't going to be working at that property too much longer. That was a little bit tough.
Yeah, well, that would be a tough conversation to have before Thanksgiving. Why was it that the seller waited so long to really kind of sort this out with his employees?
So, he had mentioned he had told some of the employees that, or the resident manager at least, that they would be selling the building, but they hadn't conveyed our position that we didn't operate in the way they did with on-site management, with on-site maintenance for that small of a property. So I think it was a little bit of a miscommunication, but also a little bit of maybe them not wanting to have that real tough conversation. And you never know until the deal closes that it's actually going to close. So on their part, I think maybe protecting a little bit of their interest too. But either way, I think it got handled well. We showed up at the property, and we did offer the on-site manager a position in our office. We just operate a little bit differently and operate out of an office. We offered her a position there. We offered their maintenance people positions with our company, which we had to add anyways. And so we were able to modify it and make it work. Neither of them ended up being what it didn't work out with either of them, so they're not with us. But we did give them a shot. But more ironic than that was when I went down there to introduce myself, 3:00 in the afternoon at the day before closing. The resident manager says, "Oh, I'm glad that you're here because we now have 3 no heat calls. It's just gotten to be winter." And I said, "What do you mean you have 3 no heat calls? I'll be lucky if we can get somebody out, today, tomorrow, anything." And that's not how we like to operate. So we went into this instant scramble mode, trying to get HVAC companies out and trying to fix these units, and it ended up being quite a shambles the first couple of days, just based on the timing of everything. And I think it was just unfortunate timing. I don't think there was anything hidden there, but what that continued for several weeks. And anytime you have a change of season like this, right here, the winter was taking over. That's when you're going to have issues with furnaces, with heat, and whatnot. We always do, and out of 40 units here over a 30-day period, the initial 30-day period, we had 10 units have a no heat problem. So we had to send HVAC companies out to 10 out of 40 units, which is far, far above anything I've ever done. And it gets into some of the unknowns. What we later found out was that these prior owners, as large as they were doing a lot of their own they had their own HVAC licensed maintenance person in-house, and they were doing their own HVAC maintenance, but they were doing a lot more maintenance than what we would typically do. Therefore, had replaced probably fewer units than we would typically replace because they were able to fix them in-house. So it created a little bit of an initial drag, and it's just one of those things. That's exactly why when the returns pencil out to 20 or 21 or whatever percent, I say, nah, I think it'll be more like 16 to 18, because I had no way of knowing that was going to happen, but there's always something that comes up.
Yeah. Now, and that's when you go from the theoretical, number crunching and during your due diligence to the real world. Once you take over the property,
right?
You find, okay, well, now we have to replace. How many units did you have to replace?
We were able to get by with, I think, out of that 10 there, we replaced 4 of them, and we were able to have our HVAC company repair, the other 6 or so.
Yeah, so that's $12,000 right up front to replace.
But that's a big ding to especially when you're first starting out and you want to build up a little bit of reserve, and it's always unpleasant when those surprises come up, but that's exactly why we plan for the unknown to hurt our return a little bit. It's happened every building, probably every property I've ever taken over to some extent. There's always something. And then there's always those few tenants whom we're either getting away with non-paying rent or late paying of rent, which we really don't handle very well at all. And so we had a little bit of an economic vacancy pop up, and we had two of the tenants, which is it's really equates to 5% of the overall occupancy that we had to go through with evictions on the first month. And that's, I fully expect that. I actually always plan that our occupancy is going to dip right off the bat. But even barring those, even with those issues that we had, the property was still really took off performing very well.
By the way, I think it is important, if you have the tenants who decide they don't want to pay rent once you take over, to evict them immediately.
Right.
Because it sends a signal to everyone else that, hey, you're not a management company to be trifled with. I mean, if you pay your rent, or you're going to be evicted.
Right. And we've had, in previous cases, I've had deals where our occupancy has dipped as much as maybe 20% because of basically a rent payment issues. It makes me wonder what was actually happening before we took over, if the old management was limping these people along, or if they were hiding anything. But they definitely weren't screening the way that we would screen, because you see those things pop up, and that's just the nature of it. But over time, those things work themselves out, and the performance of the building improves dramatically. Your physical and economic occupancy will end up being very, very similar numbers.
So what kind of upside are you seeing? I mean, are you seeing the ability to increase rents?
We are somewhat. So we also are in a little bit of a tough time of year to really make any big calls. So we started with an initial just $20 a door increase. We took over at 95% occupancy. So we had 2 vacancies, and we were able to fill one of the initial vacancies at a slightly increased rent fairly quickly. So we're feeling out the market. The the other unit was the manager unit that required a turnover because it was, I think I mentioned, an office or a converted office. So we haven't got that one listed as of yet, but I'm confident that we'll see a little bit higher rent per door when we do have that ready to go. And then also timing of the year. I don't want to set my rent goals or my rent targets based on what we try to lease over the Christmas holiday and New Year's and whatnot. That's historically the toughest time. So we should know more in the coming months on what our actual numbers would be, but I'm confident that even at $20 per door increase, we've already met our 7.5% NOI increase. So I'm pretty confident we'll be looking okay there.
So you're off to a great start. What about your investors? How often do they get distributions, and have you done the first distribution yet?
So our first distribution was slated. We do distributions the 15th of January, April, July, and October every quarter.
So quarterly.
Yeah, quarterly distributions, and we don't get a full first quarter because of when we closed. So there won't be any first quarter distribution. Second quarter will be on the fence because we're building up a $20,000 reserve. Again, we didn't overfund this deal, so we are building up a little bit of reserve. But we should be distributing. I have no doubt we'll be distributing, if not by second quarter, by third quarter for sure.
So you prepared your investors in advance that you'd be building up some funds before you begin distributions.
Right, and we've done some unique things with the building even since closing, but I had prepared investors that there's always that lag on any kind of deal you take over. Now we're making up for the attorney costs getting into the deal. We're making up for the initial takeover, simple things like changing a sign out or changing, we go to a different lock system on all the units. All those initial drags on the investment work themselves out in the first few months. So I believe everyone is completely prepared for that. We definitely made it clear to them that's how we operate. Just like I mentioned before, you've got to get that building on that upward spiral. Even if it was running okay, you got to give it a little kick, a little boost to really start getting it running. So once that's taken care of, we also, with the way taxes fall, we get hit with a big tax bill fairly quickly, and we don't have time to build up an escrow yet. So those things all hurt initially, but the building is performing very, very well.
Any other surprises once you took over this property?
Really, we didn't have any surprises, but one of the other things that we had planned for the investors, we had proposed was in year 2, we knew these roofs one of the only CapEx items really needed were roofs and windows. So we planned to do roofs in year 2 and calculated that into our return numbers accordingly. And we plan to do windows in year 4. And the plan was to take those from quarterly distributions to deferred distributions, albeit not right off the bat. We were going to do that, in years 2 and 4 to get a little bit of funds coming in first. What actually happened was we took over the building, and the roofs aren't leaking or anything. They're towards the end of their life, and everyone knows it. But we were able to come up with, through some other contacts I have and through a roofing company that I work with very, very closely, just the deal of a lifetime on replacing roofs and doing siding at the same time for a price that's under what we thought just roofs would be. So we ended up going with a huge facelift of the property only about 3 months in. That wasn't really necessary. And although I do have the authority to go ahead and make that decision on my own, I sent out an update. I try to send at least monthly, if not every couple weeks, updates or anything significant out to the investors. And I just asked for a quick response. This is where I'd like to go with this. What's your feedback? I don't know if you do that much with your syndications, or if more your investors prefer to stay completely passive. But it was nice for me, especially on my first big decision, to just take a lay of the land, get a feel of their thoughts.
Yeah, and what kind of feedback did you get?
Overwhelmingly, and a little bit to my surprise, if this was just me in this deal, it would have been a no-brainer. We're getting, roofs and siding done for less than what roofing would cost. I mean, this is going to be great. I would have done it in a heartbeat because I'm all about reinvesting into the property. I was concerned my investors would think that. I knew that they want to see some distributions. Surprisingly to me, every single person, 100% of the investors within a few minutes had responded to that email saying, we think that's a great decision. We'd love to see you go with it. Unanimous. So it made it really, really nice to know that really not just that they wanted to move forward with this project, but that I've got people in this deal with me that have the same mentality and understand the deferred gratification necessary in order to make the investment down the road what it could be or even better. So it was really, really comforting to know that it was the first test, and I've got the backing that I need, and that's great.
Yeah, and it's important to keep in mind too. You have accredited and sophisticated investors you're working with, and that's an important differentiation, because accredited and sophisticated investors understand the responsibility they have to the investment as well. And that spending that money and getting that kind of deal and spending it now saves them money over the long term, and also goes toward the overall health of their investment. So I think it's great that your investors responded the way they did. I mean, I certainly the investors I work with would respond the same way, I'm sure. But they just understand, let's defer our gratification as far as getting an equity check this quarter, or having a little less in our equity check, in order to just improve the health of the investment overall.
Right. It was a very, very nice response to have. It really gave me some encouragement that just knowing we have the right people in here and a great group of investors in this deal. Any
of our listeners who find this interesting and are looking to do it themselves, find this kind of apartment deal and raise the money through syndication, what are some actionable tips that you can give them to help them on their way?
I guess the biggest and most important thing, I think, is to find the right deal. Because if you don't have a deal that will support a bunch of different pieces of that pie going out to several different people, you can't force a syndication. You can force a deal when you're the only person in it yourself, because there's really no one to answer to but yourself. But when you have multiple different investors and a sponsor needs to have some type of override to make it worth their while, the investors need to have a significant return to justify their investment, the deal really needs to be there. So really it's the same thing that goes into finding a good deal. You need to be out there looking at all kinds of deals, as many deals as you can, but most importantly, you need to be out there building relationships with the people that are going to bring you those deals, and those are those commercial brokers. And I think a deep relationship with them, where you feel that broker is a friend of yours, more so than even just a business, a colleague. Those deep relationships are what have always brought me to that first look at those deals, or getting those deals before they hit the market. And that's what gives us the potential to have that awesome opportunity to put a bunch of investors together and make this thing happen.
That's great, actionable advice. And any other advice you might have?
Yeah, I think something really important to do, and what we try to do with every deal we get into, is plan for things to pop up that you didn't expect. Plan for the unknown unknowns, because if you get into a deal and you try to inflate that deal, you try to justify a higher return to your investors than you are actually coming up with, or even right at where you believe you'll be, and then anything pops up that you didn't expect, now you're going to go in and you're going to have to come to these investors or to anyone and say, look, I thought we would be at 16 to 18%, which is really what I penciled this out to, but this happened and this happened and this happened, and we're only at 9%. And to me, that's the first way to make sure you don't have anybody to participate in future deals. Whereas if you do the opposite, if you underpromise this a little bit, and sure, I think we might get better rent growth than what I put on paper and in the PPM, and if we do, that's great. I would love to see everyone make much higher returns than projected, but that's what's key. Just plan for that unknown, just those things that you can't see coming and you don't even know what they are.
Well, Josh Sterling, thanks so much for taking the time to really walk us through this deal. I mean, it's been a great education for me and hopefully for our listeners. Thank you so much, and good luck with this project.
Well, thank you. I appreciate it. It's very nice getting a chance to share the story, and I hope it encourages other investors that have been on the fence about moving forward and growing their investment career by seeing that you can. It's not as hard as it sounds to get out there and find a deal that everyone can participate in.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.